Ever wondered which investment strategy wins in the long run? Dollar cost averaging or buying the dip? Well, we're about to take a deep dive into these two popular investment strategies, breaking them down to their bare bones. Let's start with dollar cost averaging, a strategy where you invest a fixed amount regularly, regardless of the market's ups and downs. The beauty of this approach lies in its simplicity and consistency, taking the emotional guesswork out of investing. On the other hand, we have buying the dip, a strategy that attempts to capitalize on market declines. Its proponents wait for prices to drop by a certain percentage before investing, aiming to snag those bargain deals. Sounds tempting, right? But timing the market accurately is a tricky business, and even the pros often miss the mark, leading to missed opportunities or less than ideal entry points. In the next few minutes, we'll delve deeper into these strategies and see which one comes out on top. Dollar cost averaging, or DCA, is a strategy that involves investing a fixed amount regularly, regardless of market fluctuations. Think about the concept of DCA as a steady rhythm in the chaotic symphony of the stock market. You're not trying to hit the high notes or avoid the low ones. You're consistently playing the same tune, come rain or shine. This consistency is what makes this strategy an appealing option for many investors. The primary benefit of dollar cost averaging is that it reduces emotional decision-making. Let's face it, the stock market can be a roller coaster ride, and it's easy to get swept up in the highs and lows. By investing a fixed amount regularly, you're taking the emotion out of the equation. You're not trying to time the market or make predictions about what's going to happen next. You're sticking to your plan, no matter what. Another advantage of DCA is that it fosters consistency. By investing regularly, you're not only reducing the risk of making impulsive decisions based on market fluctuations, but you're also building a habit of investing. This habit can be incredibly beneficial in the long term, as it allows you to accumulate wealth over time, thanks to the magic of compound interest. Moreover, DCA can help mitigate the impact of market volatility. By investing a fixed amount regularly, you're buying more shares when prices are low and fewer when prices are high. Over time, this can result in a lower average cost per share compared to making a lump sum investment at a potentially unfavorable time. However, it's important to remember that while DCA reduces the risk of investing at the wrong time, it doesn't eliminate it. The stock market is unpredictable, and even the most disciplined investment strategy can't guarantee success. By now, you should have a good understanding of dollar cost averaging. But what about buying the dip? Buying the dip is a strategy that tries to capitalize on market declines. Now, let's take a closer look at what this means. In essence, buying the dip is akin to shopping for bargains during a sale. When the market is in a downturn, prices of assets drop, making it theoretically a prime time to invest. The rationale here is simple. Buy when prices are low and reap the benefits when they bounce back up. However, while this strategy may sound appealing, it's not without its pitfalls. The most significant of these is timing the market. You've probably heard the old adage, time in the market is better than timing the market. Well, there's a reason for that. Timing the market accurately is notoriously difficult. Even seasoned professionals often struggle to predict when the market will dip and, more importantly, when it will start to recover. This can lead to investors missing out on potential gains during a rebound. Additionally, waiting for a dip can sometimes mean waiting indefinitely. The market doesn't operate on a schedule, and there's no guarantee that a significant drop will occur when you want it to. Plus, there's the emotional aspect of investing. It can be nerve-wracking to invest large sums during a market downturn. Fear and uncertainty can cloud judgment, leading to hasty decisions and potential losses. Now, it's important to note that buying the dip isn't inherently a bad strategy. It can, in fact, be quite profitable if executed correctly. But it requires a level of knowledge, patience, and nerve that not all investors possess. So, we've delved into the mechanics of dollar cost averaging and buying the dip. We've explored the regular, consistent approach of the former and the opportunistic, timing-centered approach of the latter. Both strategies have their merits and drawbacks. So we now know what dollar cost averaging and buying the dip are, but which strategy is better in the long run? Stay tuned as we delve deeper into this question in the next segment. Let's consider two investors, Alex and Jordan. Alex uses DCA, while Jordan waits for a 10% market dip to invest. Imagine a roller coaster. That's the financial market for you. It's filled with ups and downs, twists and turns. Alex and Jordan, our two investors, are aboard this roller coaster, but they've chosen different ways to ride it. Alex, who uses dollar cost averaging, or DCA, is like a steady passenger. He invests a fixed amount regularly, regardless of the ride's intensity. Whether the market is up or down, he's consistently putting his money in, buckled up for the long haul. Jordan, on the other hand, is waiting for the big drop, the 10% market dip, before he invests. He's seeking that thrill of buying on sale, hoping to capitalize on market declines. He's trying to time the dips to get the most bang for his buck. But here's the catch. The market, like a roller coaster, is unpredictable. Jordan might be waiting for a dip that doesn't come when he expects, or worse, it comes, but he's not ready to invest. Meanwhile, the market has rebounded and Jordan has missed the boat. He's left on the platform while the roller coaster, with Alex aboard, is already climbing to new heights. In contrast, Alex, with his consistent investment approach, is capturing average market returns. He might not be hitting those thrilling highs that Jordan is chasing, but he's also not missing out when the market rebounds. His steady approach is paying off in the long run, proving that consistency can be a winning strategy. Now, this is not to say that DCA is always the superior strategy. There will be times when buying the dip could yield higher returns. But these instances are rare and highly dependent on perfect timing, which is notoriously difficult to achieve, even for the pros. As we can see, dollar cost averaging has the potential to yield better results than buying the dip. But let's look at a real-world example to confirm this. Charles Schwab conducted a 20-year study examining different investment behaviors in the S&P 500 from 2003 to 2022. In this comprehensive research, they evaluated the outcomes of various investment strategies, including dollar cost averaging and buying the dip. The study followed hypothetical investors making annual contributions of $2,000, examining their returns under different investment approaches. One of the key findings of the study was how difficult it is to time the market perfectly. The highest returns were seen by those who invested their lump sum at the absolute market bottom. But let's be honest, how often does someone manage to do that? Here's where dollar cost averaging comes into play. The study found that those who regularly invested, regardless of market conditions, came very close to the returns of the perfect timers. The difference was not substantial enough to justify the stress and uncertainty of trying to predict the market's ups and downs. Furthermore, the study revealed that investors who delayed their investments or tried to time the market often underperformed the regular, disciplined dollar cost averagers. This is because they often missed out on periods of significant gains, waiting for a dip that sometimes never arrived, or investing after a substantial part of the recovery had already occurred. This research goes to show that while it might be tempting to try and buy the dip or time the market, these strategies often fall short in practice. They require a level of precision and foresight that even the most experienced investors struggle to achieve consistently. Instead, the steady, emotion-free approach of dollar cost averaging can yield near optimal returns, while also reducing stress and the risk of making ill-timed investment decisions. It allows investors to benefit from market fluctuations over time, smoothing out the highs and lows to capture the market's average return. This study shows that while lump sum investing at market lows yields the highest return, regular investments via DCA are a close second. So, while it may not be as thrilling as trying to time the market, dollar cost averaging proves to be a reliable and effective strategy for long-term investing. So, what's the takeaway from all this? Well, investing isn't a one-size-fits-all game. Dollar cost averaging offers the advantage of regularity and removes the emotional factor, while buying the dip can be tempting as it aims to capitalize on market declines. But remember, timing the market perfectly is often a fool's errand, even for seasoned investors. Our fictional friends Alex and Jordan demonstrated this, with Alex's steady approach yielding more consistent results. The 20-year study by Charles Schwab further underlines this, showing that while lump sum investing at market lows can yield the highest return, regular investments via dollar cost averaging come close and often outperform inconsistent or delayed investing. Perhaps a hybrid approach, where you maintain a disciplined DCA plan while holding some cash to deploy during significant drops, could be your sweet spot. Above all, consistency is key. As Warren Buffett advocates, consistent investing in low-cost index funds is often the smartest choice. Remember, the best investment strategy is the one that aligns with your personal financial goals and risk tolerance. Happy investing!